Hey everyone, welcome back to Corporate Decoder, your go-to channel for cracking open the financial secrets of the corporate world. Today we are diving into a filing from First Trust Exchange traded fund, the Ants, and let me tell you, it's packed with enough numbers to make your head spin unless we decode it. So grab your coffee because we're about to break down what's really going on under the hood, and don't forget to join our awesome community on Discord linked in the description below. It's the best place to chat about these filings. Alright, so this is a report for First Trust Exchange traded fund, the VIII, which basically acts as a parent company for various exchange traded funds or ETFs. Today we are going to focus on two specific ETFs within this trust. First up, we're looking at the First Trust Active Global Quality Income ETF, or AGQI. This ETF focuses on income producing stocks and aims for capital growth. So let's talk about cost, because we all want to know where our money is going. For AGQI, last 6 months, a hypothetical 10,000 investment saw costs of $23. That sounds pretty small, right? Now remember, they mentioned that this ratio, meaning the percentage of the investment that went to costs, was 0.44%. This percentage is actually pretty good when you consider what it includes. They also mentioned that if it weren't for a payment received from insurance related to extraordinary legal fees and a tax expense, the ratio would have been higher. This tidbit suggests that while the fund is generally managed efficiently, there were some unexpected expenses that were offset. Now let's hit the key numbers for AGQI. For the period ending May 31, 2025, the fund had total net assets of about $55.2 million. That's how much money investors have put into this specific ETF. The total number of holdings, meaning the number of different stocks and other investments it owns, is 33. That's a relatively concentrated portfolio, and the portfolio turnover rate typically suggests a strategy that is not overly aggressive in traded portfolio, and the portfolio turnover rate typically suggests a strategy that is not overly aggressive in traded portfolio. And the portfolio turnover rate typically suggests a strategy that is not overly aggressive in traded portfolio. And the portfolio turnover rate typically suggests a strategy that is not overly aggressive in traded. Portfolio and the portfolio turnover rate typically suggests a strategy that is not overly aggressive in traded portfolio. And the portfolio turnover rate typically suggests a strategy that is not overly aggressive in trading. Now for the juicy part, the top holdings. These are the biggest bets the fund is making. AGQI's top holding is Taiwan Semiconductor Manufacturing Co. Limited at 50%. This is a huge player in the semiconductor industry. Then we see Microsoft Corp at 4.7%. BAE Systems PLC at 4.5% and Relex PLC at 4.4%. These are all big, well-established companies. The fact that the top 10 holdings make up a significant portion of the portfolio, with the top one alone being 5%, indicates a strategy that is focused on a select group of companies. Next up is the FT Energy Income Partners Enhanced Income ETF, or EIPI. This ETF has a different focus, aiming for a high level of total return with an emphasis on current distributions, essentially meaning it wants to pay out a lot of income to its investors. It primarily invests in companies within the energy sector. Let's look at the costs for EIPI. For a hypothetical 10,000 investment, the costs over the last 6 months were $56, which translates to 1.4% of the investment. This is noticeably higher than AGQI. They also mentioned that this includes tax expense, and if tax expense were excluded, the ratio would have been 1.110%. This higher expense ratio means a larger chunk of your investment is going towards fees and operational costs compared to AGQI. For an income-focused ETF, you'd want to see those costs kept as low as possible to maximize distributions. Now for EIPI's key statistics. This fund is significantly larger than AGQI with net assets of over $902 million. That's a massive difference in scale. It holds 111 different investments, making its portfolio much more diversified than AGQI's 33. Its portfolio turnover rate is 64%, which is quite a bit higher than AGQI's 37%. This higher turnover suggests more active trading within the energy sector, possibly trying to capitalize on more frequent opportunities. Let's check out EIPI's top 10 holdings. Enterprise Products Partners LP is the largest at 7.7%. Energy Transfer LP is second at 6.7%. And MPLX LP is third at 4.6%. We're seeing a heavy concentration in energy infrastructure and midstream companies here. Companies like Kinder Morgan, 1. Okay, along with major players like ExxonMobil and Shell also feature in the top holdings. This focus on energy infrastructure and oil and gas companies makes sense given the ETF's stated objective Now let's dig into the actual investments. For AGQI, the portfolio of investments shows their top common stock holdings. It's interesting to see how the sector allocation is broken down, with diversified telecommunication services, electric utilities, and software all making up portions of the portfolio. The valuation input section is key here. It shows that all of AGQI's investments as of May 31, 2025, a total value of over $54 million were categorized as level 1 inputs. Level 1 means these are investments with readily available quoted prices in active markets like stocks traded on major exchanges. This indicates that the fund primarily holds liquid, publicly traded assets, which is generally a good sign for transparency and ease of valuation. Looking at the statement of assets and liabilities for AGQI, we see that its total assets were over $55.7 million. Liabilities were much smaller, around $553,000, leaving net assets at that $55.2 million figure we saw earlier. The breakdown of net assets is also important, showing paid-in capital versus accumulated earnings or losses. For AGQI, accumulated distributable earnings showed a loss of over $67 million. This doesn't mean the fund is failing, but rather reflects the accounting of gains and losses and distributions over time. The net asset value per share was $15, leaving assets at that $55.2 million figure. We saw earlier the breakdown of net assets is also important, showing paid-in capital versus accumulated earnings or losses. For AGQI, accumulated distributable earnings showed a losses for $7 million. This doesn't mean the fund is failing, but rather reflects the accounting of gains and losses and distributions over time. The net asset value per share was $15. The statement of operations for AGQC details how the fund made or lost money during the 6-month period. Investment income, mainly from dividends, was over $1 million. Expenses were much lower, just under $120,000, leading to net investment income of about $1.15 million to net assets of over $4 million from operations. Other 12 used an annual report or $50 million, and the change in unrealized appreciation, meaning the increase in the value of its holdings, was over $1.6 million. This resulted in a net increase in net assets of over $4 million from operations. The statements of changes in net assets gives us a picture of how the fund's net assets have changed from the beginning to the end of the period. For AGQI, operations resulted in an increase of over $4 million in this 6-month period. However, shareholder transactions, which means when people bought or redeemed shares, actually led to a decrease of over $2.7 million during this reporting period. It's important to see how investor activity impacts the fund's overall size. Now, the financial highlights, this is where you see the performance per share. For AGQI, the total return for the 6 months ended May 31, 2029, won 7.90%. That's a solid return. The ratio of total expenses to average net assets, that cost percentage we talked about earlier, was 0.44%. This is the important number for understanding the fund's efficiency. This also helps us understand the story behind the numbers, and then we have the notes to financial statements. These are crucial for understanding the details. For AGQI, they mention that the fund is considered an investment company and follows FASB guidance. Under portfolio valuation, it states that level 1 inputs are quoted prices in active markets for identical investments. This confirms that AGQI primarily holds highly liquid securities. The notes also detail the investment advisory fee. For AGQI, the advisory fee is 0.85% of assets, but they mention a reduction due to breakpoints based on the fund's net assets. They also explain the sub-advised by VIII would be going 8 the advisory fee as 0.85% of assets, but they mention a reduction due to breakpoints based on the fund's net assets. They also explain the sub-advisory fee paid to Janus Henderson. It's good to see that they are transparent about who is managing the money and how they are compensated. Let's switch gears back to EIPI. We saw that EIPI has a significantly higher expense ratio at 1.14% compared to AGQI's 0.44%. This means more of your investment is consumed by fees, which is something income-focused investors need to watch closely. Looking at EIPI's portfolio of investments, about 67.9% is in common stocks, and a substantial 27.5% is in master limited partnerships or MLPs. This confirms its heavy focus on the energy sector. The holdings reflect this with high concentrations in companies like Enbridge, Kinder Morgan, and ExxonMobil. The valuation inputs for EIPI are also interesting. While most of its assets like common stocks and NLPs are level 1, valued at over $900 million total, there's a mention of level 3 inputs for a specific security valued at just over $3,600. Level 3 inputs are unobservable, meaning they are based on the company's own assumptions rather than market prices. This is a very small portion of the portfolio, but it's a reminder that not all investments are easily valued. For EIPI, the statement of assets and liabilities shows total assets of over $910 million. Liabilities are around $8.25 million, consisting of things like options contracts written, payables for advisory fees, and redeemed shares. This results in net assets of over 923.5 cents. In EIPI's statement of operations, investment income was a strong $12.4 million. However, expenses were also quite high at over $5.3 million, bringing net investment income to about $7 million. The big story for EIPI, though, is in the realized and unrealized gains and losses. They had significant net realized gains of over unfolding from in-kind redemptions and written options contracts. But they also experienced a massive net change in unrealized depreciation on investments, a loss of nearly $73.4 million, including from in-kind redemptions and written options contracts. But they also experienced a massive net change in unrealized depreciation on investments, a loss of nearly $73.4 million. This unrealized loss, essentially a decrease in the market value of their holdings that haven't been sold yet. Significant in net realized gains of over $40 million, including from in-kind redemptions and written options contracts, but they also experienced a massive net change in unrealized. The statements of changes in net assets showcase this impact dramatically. For EIPI, the operations resulted in a decrease of over $25 million. On top of that, shareholder transactions, which include share redemptions and sales, led to a further decrease of over $30 million in this reporting period. This is a significant contraction for a fund of this size. Let's look at the financial highlights for EIPI. The total return for the period was negative 2.52%. This reflects the large unrealized losses we saw. The ratio of total expenses to average net assets, that 1.14% we discussed, is also important here. It's more than double what AGQI is paying. The notes for EIPI offer critical context. They mention that on October 23, 2023, the fund underwent reorganizations, basically merging with other energy ETFs like VIII, VIII, and FPL. EIPI is the surviving entity, and the numbers reflect this transition. The notes also explain their strategy of writing options to generate income, which is a common tactic for income-focused ETFs. The section on securities, transactions, and investment income for EIPI shows that they had significant purchases and sales of investments, totaling hundreds of millions of dollars, which aligns with its higher turnover rate. Their derivative transactions note is particularly interesting. It reveals that EIPI had written options contracts worth about $5.4 million. These are essentially bets that the price of underlying assets won't go up past a certain point. The fund also realized significant gains from these options, but faced unrealized losses, highlighting the risk involved in these strategies. Now, for my take on this, AGQI appears to be a more stable, albeit smaller, fund focused on quality income producing companies. Its lower expense ratio and level 1 valuations suggest a straightforward and efficient investment approach. The positive total return and strong net asset value increase from operations in this period are encouraging signs for its strategy. EIPI, on the other hand, is a much larger fund with a more aggressive strategy. Its heavy investment in MLPs and its use of options trading are designed to juice income. But as we've seen, this also comes with higher volatility and higher fees. The significant unrealized losses in this period demonstrate the inherent risks of its approach, especially in a fluctuating energy market. While they did generate income and realize gains from options, the overall net asset decrease is a concern. Investors in income-focused funds often prioritize stability in distributions, and this kind of year-over-year swing in value can be unsettling. The higher expense ratio for EIPI also means that investors need to see consistently superior performance to justify the cost. In conclusion, AGQI offers a more conservative, diversified approach with lower costs, while EIPI targets higher income with greater risk and higher expenses. Which one is better depends entirely on an investor's risk tolerance and income needs. Alright, that's our deep dive into First Trust Exchange Traded Fund, the AT's latest report. What do you think about these ETFs? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate financial decoded content. And don't forget to join our Discord community, the link is in the description. It's the best place to keep this conversation going. Thanks for watching, and we'll see you next time here at Corporate Decoder.